Hey everyone, welcome back to Corporate Decoder, the place where we unravel those complex corporate filings, because let's be honest, sometimes they read like a secret code. And today we have a really interesting one. We're diving into the financial report of Clifford Capital Partners Fund, and let me tell you, it has got some juicy tidbits about how their investments have been performing. Stick around because we're going to break down exactly what these numbers mean for the fund, and by extension, for the investors who trust them with their money. And hey, if insights like these are your jam, hit that subscribe button. Also, we've got a fantastic community over on Discord. Linked in the description below, where we keep the conversation going long after the video ends. Alright, let's get into this annual shareholder report for Clifford Capital Partners Fund. The report covers the period from the 1st of October 2024 to the 30th of September 2025. They offer different classes of shares, investor class, institutional class, and super institutional class, each with slightly different cost structures and tickers. Let's talk performance for the year ending the 30th of September 2025. The investor class shares returned 15.08%. Not too shabby. But how did that stack up against the market? Well, the broad US market, as tracked by the Russell 3000 index, did a bit better at 17.41%, and their benchmark, the Russell 3000 Value Index, returned a lower 9.34%. So why the difference? The report says US stocks, especially those in technology and with exposure to artificial intelligence, really took off. The fund didn't quite catch that wave as much as the broader market, mainly because of underperformance in its technology, healthcare, and consumer staples holdings. They did get a bit of a boost from having less in real estate and materials stocks, which is interesting. The funds focus on companies with lower valuations and slower growth, which is a value investing approach, didn't quite get the bang it usually does in this particular market cycle. They mentioned that market rotations like that early 2025 surge in AI stocks and later speculative runs made it a tricky environment for value stocks. Now, let's look at the long game. This table shows how a hypothetical $10,000 investment would have grown over time for each class and the indexes. Starting way back in 2015, that $10,000 in the Clifford Capital Partners Fund investor class grew to $28,875 by the 30th of September 2025. The Russell 3000 index would have turned that into a hefty $39,446, while the Russell 3000 value index would have resulted in $27,462. So over a decade, the fund lagged the broad market but managed to beat its specific value benchmark. This next table breaks down the average annual returns for the 1 year period ending the 30th of September 2025. Investor class hit 15.08%. Over 5 years, it's 12.93%, and over 10 years, it's 11.19%. Comparing those to the Russell 3000 index at 17.41% for 1 year and 15.74% for 5 years really highlights that the broad market has been the bigger winner recently. Let's peek at where the fund is putting its money. As of the 30th of September 2025, the biggest sector allocation is healthcare at 24.21%. Following that, we have financials at 20.53%, and then industrials at 15.18%. Consumer staples and consumer discretionary are also significant chunks. Communication services and energy are much smaller allocations. And who are their star players? The top 10 holdings give us a clue. Solventum Corp is their biggest bet at 4.41%, followed closely by Henry Schein Incorporated at 4.26% and NCR Atleos Corporation at 4.20%. It is interesting to see companies like Johnson & Johnson and Becton Dickinson and Company in there, all within the healthcare and financial sectors. This tells us they believe in the long-term prospects of these specific companies. Looking at the key fund statistics, the total net assets for the fund as of the 30th of September 2025 were $133,817,081. That is a pretty decent sum. They hold 32 different investments, and the total net advisory fee, the money paid to the advisors, was $585,463. The portfolio turnover rate, which indicates how often they buy and sell investments, stands at 71.51%. That's a moderate turnover, suggesting they aren't constantly trading but are actively managing the portfolio. Now, let's switch gears to the institutional class shares. For a hypothetical $10,000 investment, the costs here were $97, or 0.90%. This is lower than the investor class, which we saw earlier was $124, or 1.15%. That difference in fees really adds up over time for investors. The institutional class actually did a hair better, returning 15.23% for the same period. Again, it lagged the Russell 3000 index, but outperformed its value benchmark. The The key factors affecting performance are pretty much the same across the classes, as you'd expect. For the institutional class, that hypothetical $100,000 investment from the 30th of September 2015 grew to $295,167 by the 30th of September 2025. That's a solid growth, but again, the Russell 3000 index would have more than doubled that amount to $394,462. The average annual returns for the institutional class are slightly higher than the investor class, with 1 year at 15.23%, 5 year at 13.21%, and 10 year at 11.43%. This demonstrates that the lower fees of the institutional class translate into slightly better net returns for investors. Moving on to the super institutional class shares here. The cost for a hypothetical $10,000 investment is just $88 or 0.82%. This is the most cost-effective option, which makes sense for the largest investors. Performance for the super institutional class was 15.40%, again very similar performance to the other classes, which is typical since they all invest in the same underlying assets. They also mention the same market factors influence this class's performance. A hypothetical $1 million investment in the super institutional class from its inception on the 17th of October 2019 grew to $1,815,779 by the 30th of September 2025. This is a decent return. But notice the Russell 3000 index brought in a much higher $2,378,395 over that same period. The average annual returns for the super institutional class are 15.40% for 1 year, 13.30% for 5 years, and 10.53% since inception. These numbers, while respectable, consistently show the fund trailing the broader market but generally beating its specific value index, especially over longer periods. Now, let's really dig into the nuts and bolts, the actual investments. This is the schedule of investments as of the 30th of September 2025. We see the breakdown percentages we mentioned earlier. In communication services, they hold the Walt Disney Company and Warner Bros. Discovery Incorporated. For consumer discretionary, we see Bath & Body Works Incorporated, eBay Incorporated, Nike Incorporated, and Perdoceo Education Corporation. Then for consumer staples, Therese Keurig Dr. Pepper Incorporated, Reynolds Consumer Products Incorporated, and Cisco Corporation. Energy sees Delicus Holdings Incorporated and Green Plains Incorporated. And in financials, a more diverse group including Columbia Banking System Incorporated, Community Trust Bancorp Incorporated, CVB Financial Corporation, Evertech Incorporated, Glacier Bank Incorporated, North Carolina R. Retlios Corporation, and Rocket Companies Incorporated. The healthcare sector, as we noted their largest holding, is packed with Becton Dickinson and Company, Cardinal Health Incorporated, Keemed Corporation, Henry Schein Incorporated, Johnson & Johnson, and their top holding Solventum Corporation in industrials. They are invested in Everest Construction Group Incorporated, H&I Corporation, Car Auction Services Incorporated, RTX Corporation, and UPS Incorporated Class B. Lastly, information technology includes Cisco Systems Incorporated and Dolby Laboratories Incorporated. Interestingly, they also have a position in a money market fund, the Federated Institutional Prime Obligations Fund, at 1.67% with an effective yield of 4.15%. This is likely for liquidity or to balance risk. Looking at the statement of assets and liabilities, the total investments at value are $134,685,429. Total assets are around $134.8 million, with total liabilities also around $1 million. This leaves their net assets at a healthy $133.8 million. The net asset value per S-share varies slightly by class. For the investor class, it is $22.25, institutional class is $22.47, and super institutional class is $22.36. These are the figures that tell investors how much their shares are worth at the close of business on that day. It is important to note that the redemption price per share for the investor class can be lower if shares are redeemed within 60 days, indicating a redemption fee. Now, the statement of operations for the year ended the 30th of September 2025. Investment income, mainly from dividends, was $2,878,879. Expenses, which include advisory fees, administrative costs, and other operational expenses, totaled about $1.4 million. After some fee waivers and reimbursements, the net expenses were just over $1.1 million. This resulted in a net investment income of about $1.7 million. But the real story here is the gains on investments. Net realized gains were over $9.5 million, and the change in unrealized appreciation added another $6.5 million. This means the fund saw significant appreciation in the value of its holdings, leading to a total increase in net assets from operations of over $17.8 million. This statement shows how the net assets changed from operations and capital stock transactions. For the year ended the 30th of September 2025, you can see that the increase from operations at over $17.8 million was the primary driver of asset growth. Capital stock transactions, which include share sales and redemptions, actually led to a decrease of almost $6.1 million. The financial highlights tables give us a per share view of performance. For the investor class, the net asset value per S-Share at the end of 2025 was $22.25, up from $19.57 at the beginning of the year. The total return for the year was 15.08%. This is a good way to track the fund's growth on a per-share basis. Looking at the ratios, the expenses net of fee waivers and reimbursements for the investor class were 1.15%. This is a key number for investors to watch, as it directly impacts their returns. The fact that they had fee waivers and reimbursements, especially into 2026 and beyond, shows the advisor is willing to absorb some costs to keep expenses competitive. The portfolio turnover rate for the investor class was 71.51%, which is on the higher side but not extreme, suggesting active management. Finally, let's touch on the notes, which provide crucial context. They explain the valuation of securities, noting that most are level 1 inputs, meaning they are based on readily available quoted prices in active markets. This is good because it means there is less subjective judgment involved in valuing the fund's core holdings. They also detail the investment advisory agreement, where the advisor provides services for a fee of 0.75% of net assets. Importantly, the advisor has agreed to limit total annual fund operating expenses to specific percentages for each share class, with the option to recover waived fees later, provided it does not exceed those limits. This is a common practice to ensure the fund remains competitive. So, what's my take on all of this? Clifford Capital Partners Fund, across its different share classes, delivered a solid return for the year, though it fell short of the broader market's strong performance. This is largely attributed to its value-oriented strategy, which underperformed growth stocks in the recent market environment. However, it did outperform its specific value index, suggesting good stock selection within its chosen style. The key takeaway for investors is the fee structure. While the super institutional and institutional classes offer lower expense ratios, the investor class, which likely has more retail investors, has a higher cost. The advisor's commitment to capping expenses is a positive sign, demonstrating a willingness to align their interests with the shareholders. The fund's top holdings are concentrated in healthcare, financials, and industrials. This sector focus, combined with a value investing approach, means that when growth stocks lead the market as they did this past year, the fund is likely to lag. However, this same strategy could pay off handsomely when value stocks come back into favor. The significant unrealized and realized gains on investments in this reporting period are a strong indicator of their stock picking success within their strategy. Clifford Capital Partners Fund seems to be executing its strategy consistently. The risks are clearly laid out, and the performance, while not outshining the broader market this year, has been competitive against its benchmark over longer periods. For investors in this fund, understanding their value-oriented approach and the current market environment is crucial to managing expectations. Alright, that wraps up our deep dive into the Clifford Capital Partners Fund's latest report. What are your thoughts on their strategy and performance? Did anything in this filing surprise you? Let me know down in the comments below if you found this analysis helpful. Please give this video a thumbs up and subscribe for more content like this. And as always, don't forget to join our Discord community for ongoing discussions. The link is in the description. Thanks for watching, and I'll see you in the next one.